This is a fundamental question for any organisation. Everyone in the business at some point needs capital. Senior management's task is to determine where to invest the capital. They do this by weighing up options using various metrics. The long-term nature of the decision means understanding conditional risk is critical in order to make sound investments which favour the share price in the long term. Why? Because this makes our investors happy. The need for capital can stem from a bright idea to improve process, or in other cases it might be a directive from the highest levels in the business. But in most cases it's simply out of necessity to repair or replace an existing asset. Either way, one thing is certain: options are the basis for all good decisions. This framing exercise is critically important and is an art form, which allows the subject matter experts to make the magic happen. Sometimes this means you need to change directions. Often the concern is that we'll go round and round in circles with complex formulas and big spreadsheets, and sometimes that's needed, but in many cases it's not. Why? Because complex inputs demand simple outputs. Often it's just a matter of digging a little deeper, and good project sponsors will welcome that. In many cases you'll hear, "I don't have time for that and my directions are clear." Project sponsors will then try to hypnotize the analysts with their demands and deadlines. Not only doesn't this work, it can lead to conflict if you have a strong capital evaluation team. Why? Because buying or building means that it becomes an asset for the long term, in some cases up to 50 years. Often the investment case is clear, moving from an obsolete piece of equipment to a smooth, simple, multifunctional new design. In this case, quantifying the benefits can be hard, but not impossible. Other times, it's just business as usual to support core operations. On occasion, it can be so significant that the result will be make or break for the enterprise. Whichever it may be, the principles are the same, and it must stack up financially. This is how teams feel when it does, without any internal bias, using clever innovation resulting from good options. The time it takes to move from a positive result to an approval is always underestimated. This is because it requires unanimous cross-functional agreement. This forces the business to look into the mirror and in many cases redraw the internal battle lines. This is what success looks like: a series of signatures. More importantly, a green light to start the project or buy the asset. So if you consider the investment framework as a lighthouse and use it effectively, it will keep you on track to achieve the ultimate goal, which is to create value.